Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Cingulate.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine you're logging into your brokerage app, right?
Yeah.
And you pull up a company, you look at the financials, and they currently make exactly $0.
Literally not a single cent.
Right. Not a single cent in trailing 12-month revenue.
Mm-hmm.
And I feel like most investors, you see that, you just close the tab immediately.
Oh, absolutely. You run for the hills.
Exactly. Yet, when you look at Wall Street, some of the smartest analysts are looking at this exact same company, and they're projecting like an explosive 56.3% annual revenue growth rate.
It's massive.
It is. They're pointing to a potential upside of almost 600%. Like 597% to be exact, forecasting a jump from its current close of, what, $3.90?
Yeah, $3.90.
Right, to an average target of $27.18. So today, our mission is to really figure out if this massive upside is, a calculated wealth-building opportunity for you, or if it's just pure speculative fantasy.
Which is the ultimate question with these types of plays.
Right, because we're talking about a clinical stage biopharmaceutical company here. So just right off the bat, how on earth does a business with no approved products get modeled for that kind of hypergrowth?
Well, you essentially have to completely rewire how you evaluate a balance sheet.
Right.
Like when you analyze a traditional business, say a retail chain or a software company.
Yeah, you look at past sales.
Exactly. You look at quarter-over-quarter growth to predict future cash flows. But in clinical stage biopharma, looking at past revenue is just a completely useless exercise because there simply isn't any.
Zero.
Right. The projected 56.3% annual revenue growth that you just mentioned, that's Wall Street modeling the future commercialization of their pipeline.
Okay, so they're pricing in the approval before it happens.
Yes. And to put that number into perspective for you, the broader U.S. pharmaceuticals market, it only averages about 10.4% growth per year.
Wow. Okay, so 10% is the baseline.
Yeah. And anything over 20% is generally considered, high growth in this sector. So modeling 56% it's explosive. It suggests analysts believe this company is going to capture massive market share the moment they're allowed to sell.
I always look at it like a massive state-of-the-art toll bridge, but it just hasn't opened to traffic yet.
Oh, that's a good analogy.
Right. Like the value isn't in yesterday's coals because there are literally no cars on the bridge yet. The gates are closed.
Right, the value's in the monopoly of tomorrow.
Exactly. Once those gates finally open, and every commuter has to use it to get to work.
That is a highly accurate framework. Analysts are essentially looking at the earnings per share trajectory over a multi-year horizon. So right now, their EPS is deep in the red. For 2024, it was negative 10.2. Yeah, but the forecast shows it improving to negative 3.63 in 2025, and then reaching just negative 0.56 by 2027.
Wait, so they're slashing their losses per share that quickly?
Exactly. It represents an underlying growth rate in earnings of about 68.9% per year as they scale. Wall Street sees a clear operational path to profitability post-approval.
Which explains the ratings, right?
Yeah, the consensus rating among analysts right now is a buy. Two of them actually have a strong buy on it, with some modeling targets up to $37 by 2026 and an absolute upper bound range pushing $58.
Okay, but I have to push back here because if I'm a listener,
Yeah.
Managing my own capital, I want to know how to stomach the short-term reality.
Sure.
Because when I look at the projected net margins for the near future, they are frankly horrifying.
They are definitely hard to look at.
We're talking about forecasted net margins of negative 533.84% in 2026. If I see a business losing 5 times what it brings in, my instinct is to panic. How do you look at that number and not just run the other way?
Well, you really have to understand the J-curve of biotech investments. A negative 500% margin sounds catastrophic in a vacuum, I know.
Right.
But in this specific sector, it just reflects peak clinical trial expenses. It's pre-commercialization manufacturing. Think about what they're paying for right now.
Just burning cash on trials.
Massive phase 3 trials. They have to pay clinical research organizations, hire regulatory lawyers to deal with the FDA and build out the supply chain so that, the second they get approval, the drug can actually ship.
So they have to build a factory before they can sell the widget.
Exactly. All that capital expenditure happens right before any revenue hits the books. You're paying for the final, most expensive miles of a marathon. The fact that the losses are projected to narrow so dramatically by 2027, it signals that the heavy lifting is almost done.
Okay, so the massive cash burn is basically the price of admission. But to justify absorbing that kind of short-term financial punishment in your portfolio, the actual product, the intellectual property, has to be pretty revolutionary.
It does.
Which brings us to the science. We're talking about the massive $10 billion plus ADHD market here.
It's a huge space.
And their primary competitive moat is something they call precision-timed release technology.
Right. So the biological mechanics of ADHD medication have always faced this one really critical hurdle. Most patients are prescribed stimulants.
Right, like Adderall or Ritalin.
Yeah, and they're highly effective at altering dopamine and norepinephrine levels in the brain to improve focus, but the delivery mechanism is fundamentally flawed.
How so?
Well, traditional immediate release profiles cause a really sharp, rapid peak in plasma concentration in your bloodstream. And then it's followed by a very steep drop-off.
Oh, I see. It's like drinking 4 shots of espresso at 8 in the morning. By 2 in the afternoon, you don't just lose focus, you actively want to take a nap under your desk.
That is the infamous afternoon crash.
Right.
It manifests as extreme irritability, sudden loss of executive function, severe fatigue, right when patients, whether they're students or working professionals, are trying to finish their day.
That sounds miserable. So how does their tech fix that?
The precision time release technology addresses that specific biological toll. It mimics that immediate release efficacy, but sustains the medication evenly over an entire active day with just one single dose.
I want to use an analogy here to make sure we're, really visualizing this correctly.
Go for it.
Think of traditional ADHD medicine like a water balloon. You pop it, and you get this massive, immediate splash of focus and energy.
Okay.
But an hour later, the water's just completely gone.
Yeah.
But this proprietary technology acts more like a sophisticated drip irrigation system. It delivers that exact same amount of water, but it releases it evenly, drop by drop, over an entire, say, 16-hour period.
That perfectly describes the pharmacokinetic curve they're achieving. They use specialized erosion layers in the pill that dissolve at highly specific calculated rates in the digestive tract.
Okay, and here's the big question. The ADHD market is already crowded with big, generic household names that are dirt cheap. Generic Adderall, Conservate, they're everywhere.
They are.
So how does a clinical stage underdog steal market share from household names that cost pennies a pill?
Well, in neuropharmacology, adherence and quality of life dictate market share. It's not just the raw cost of the pill.
Okay.
When patients experience that afternoon crash we just talked about, doctors often have to prescribe a second, smaller booster pill for the afternoon.
Oh, right. I've heard of that.
And that introduces a host of new problems. It decreases patient adherence because people simply forget to take the second pill, and it drastically increases side effects like insomnia because that second dose pushes way too far into the evening.
That makes sense. You're wired at midnight.
Exactly. So if you can offer a prescriber a single pill that completely eliminates the booster and smooths out the patient's day, you've solved the biggest unmet need in a $10 billion space. Health insurance formularies will actually pay a premium for a proprietary drug that keeps patients stable and out of the doctor's office for constant dosage adjustments.
Wow. So you aren't just selling the chemical compound. You're selling a time-release capsule of productivity.
That's exactly what it is.
You're selling the delivery mechanism that makes the chemical actually livable. But look, having a great scientific concept is useless if you don't have the cash to push it through the FDA.
The FDA process is brutal.
It is. Trials are essentially cash incinerators.
Yeah.
A great idea means nothing if they go bankrupt before approval. So let's look at how they're actually keeping the lights on.
Yeah, the financial health of any pre-revenue biotech is always a delicate balancing act. So right now, Cingulate's market cap sits around $48.14 million.
Okay, so pretty small.
Right. Very small. With an enterprise value of $42.79 million, and they maintain a current ratio of roughly 1.3.
Let's translate that current ratio for the listener. That essentially means for every dollar of debt or obligation due in the next 12 months, they have $1.30 in liquid assets to cover. Right.
Exactly. It tells us their short-term liquidity is stable enough to keep the doors open today, but the free cash flow is deeply negative.
How bad?
They're forecasted to burn through about $34 million in free cash flow in 2026 alone.
Wow.
Yeah. The return on equity is negative 275.9%, and return on assets is negative 106.6%.
Those numbers would be catastrophic in any other industry.
Mhm.
If a software company had a negative 200% return on equity, it would be over. They'd be locking the door.
Oh, absolutely. But in biopharma, this is standard operating procedure. They aren't building software, they are buying clinical data. You have to view that negative cash flow as an investment into the intellectual property moat. Though the free cash flow margins do improve, they're expected to hit negative 35.4% by 2027. But the turning point and the massive catalyst you have to pay attention to right now is a recent $12 million PIPE that closed on February 17th, 2026.
Okay, let's unpack that.
Yeah.
Because of PIPE, a private investment in public equity,
Yeah.
that is a massive signal for anyone watching institutional flow. But wait, a $12 million cash injection for a company burning through that much cash.
Right.
That almost sounds like putting a Band-Aid on a bullet wound, unless there's a bigger strategy at play.
Yeah.
Who is actually giving them this money and why?
This financing was led by life science investors, specifically a specialized fund called Falcon Creek Capital.
Oh, okay.
And when a dedicated life science fund drops $12 million directly into a pre-revenue company, they aren't doing it based on a whim or just, a shiny pitch deck.
They're doing their homework.
Heavy homework. These funds hire teams of neuroscientists and regulatory experts to conduct deep due diligence. They review the blinded clinical data, they model the FDA pathways, they evaluate the manufacturing patents.
Wow, so they get deep into the weeds.
Extremely deep. They only deploy capital if they see a clear, de-risked line of sight to approval. And following this capital injection, the company's cash-to-price ratio improved by 14%, giving them a much stronger fundamental floor.
We also saw something very interesting regarding insider alignment recently.
Oh, the CFO's bonus.
Yes.
Yeah.
Their CFO, Jennifer L. Callahan, she recently took a massive chunk of her performance bonus in company stock rather than cash.
Which is very telling.
Right. She had 15,329 shares granted. She used a portion of about 6,427 shares just to cover the tax liability, but she kept the rest. 13,961 net bonus shares in equity. If the person managing the corporate bank accounts is betting her own paycheck on the company's survival, what does that tell us about their internal confidence?
It's honestly one of the strongest bullish signals you can find. Executives at clinical stage companies, they know exactly how long the runway is. They see the daily burn rate.
Better than anyone.
Exactly. So when the CFO takes equity instead of cash, it signals supreme confidence that the current capital will be sufficient to reach a valuation-altering milestone.
But here's the psychological paradox that just fascinates me about all this. We have a specialized fund dropping $12 million. We have insiders taking stock. Yet the current ticker sentiment score across retail trading platforms is a flat zero.
Zero.
It's completely neutral. Nobody is talking about it. As an investor looking for an entry point, is this lack of retail euphoria actually a good thing?
It is arguably the best setup you could ask for as a wealth builder.
Really?
Yeah. When retail sentiment is at a fever pitch, when a stock is trending on social media, the asset is usually fully priced or actively overpriced. The risk-to-reward ratio is terrible at that point.
And everyone's already bought in.
Exactly. A neutral sentiment score means the asset is flying completely under the radar of the day traders and the algorithmic momentum bots. The institutional money is validating the science and building their positions quietly.
Which keeps the price stable.
Right. It keeps the order flow stable without triggering excessive, unpredictable volatility. It allows you to enter the trade based purely on the fundamentals and the clinical timeline, rather than trying to time a hype cycle.
Okay, the institutional backing definitely validates the thesis, but investing in clinical stage biotech is notoriously risky, and I want to play devil's advocate for a minute.
Let's do it.
We have to stress test the bear case and map out exactly what could torpedo this wealth-building opportunity. You can have the most elegant drip irrigation tech in the world, but if the FDA decides to kick the can down the road, that $12 million runway evaporates.
It does.
What is the absolute worst-case scenario here?
Well, the worst-case scenario is the ultimate binary threat of clinical or regulatory delays. This is the death knell for small biopharma. If a trial fails to meet its primary statistical endpoint, or if the FDA issues what is called a complete response letter.
What's that?
It's essentially the agency demanding more safety or efficacy data before they will approve the drug. If that happens, the timeline extends by years.
Oh, wow. Years.
Yes, and that immediately restarts the cash burn cycle. But now the company has zero momentum, they've missed their targets, and they have desperate capital needs.
And that brings up the balance sheet again. If you're looking at your portfolio right now and you see a debt-to-equity ratio of 131.8 times.
Yeah, that's a big number.
It's huge,
Yeah.
131.8 times. That probably makes you want to run for the hills.
Yeah.
If the FDA delays them, that debt becomes an anvil. Why do these companies take on so much debt instead of just issuing more shares to raise cash?
It's a strategic calculation to protect the long-term upside. Early-stage biotech companies use debt specifically to avoid diluting their stock when their valuation is still really low.
Okay, so it's a bridge.
Exactly. They lever up to build a financial bridge to the next major clinical milestone. The theory is that once they release positive trial data, their valuation will spike massively.
And then they can pay it off.
Right, allowing them to either refinance that debt or raise new equity on much, much better terms. Because the stock price is higher, but you are entirely right. If a clinical delay happens and the valuation drops, that debt becomes a crushing weight. It can force the company into a toxic restructuring.
And even with a successful clinical path, what about the dilution risks from the PIPE itself? That fresh $12 million from Falcon Creek means new shares are eventually hitting the market.
That is a valid short-term risk. Fresh capital often pressures share prices temporarily as the new supply is absorbed. However, because this specific financing was priced at the market and backed by high-quality institutional investors who actually intend to hold it, mitigates the damage.
So they aren't just flipping the shares.
Exactly. They didn't sell the shares at a massive, desperate discount to toxic lenders just to keep the lights on. It's strategic financing meant to manage the runway specifically to get them to the next data readout.
Which brings us to the timeline. Weighing this incredible moat against the undeniable risks of the FDA process, we need to know the catalyst calendar. Why is Wall Street positioning for this right now instead of, say, next year?
Well, the immediate horizon is the next earnings report, which is expected this coming April, around April 2026.
Okay. What are we looking for there?
Consensus anticipates management will show narrowing quarterly losses around negative 16 million, which would confirm they are tightening the operational belt and stretching that new capital effectively.
That would be a good sign.
Yes. But the real volatility events are the potential ADHD trial updates or investor days that usually follow a major capital raise. We're entering a window where major industry conferences focusing on central nervous system disorders are scheduled.
Perfect place to show off the tech.
Exactly. It provides the perfect platform to present this precision-timed release data to larger pharmaceutical partners.
And we cannot ignore the macro tailwinds swirling around this sector right now. It really feels like we're looking at a perfect macro storm. We've got falling interest rates making biotech capital cheaper, crashing right into a massive post-pandemic surge in ADHD diagnoses.
The macro environment is the hidden engine driving these valuations. Biopharma companies are essentially long-duration assets.
Because the payoff is so far out.
Right. Because they don't make money today, their cash flows are modeled years into the future. When interest rates fall, the discount rate applied to those future earnings falls, which makes the present value of the company surge.
Yeah.
We are seeing a major sector rotation underway where capital is flowing back into clinical plays like Cingulate for this exact reason.
And on the demand side, I mean, telemedicine and reduced cultural stigma have just drastically expanded the total addressable market for ADHD treatments.
Precisely. You combine cheaper operational capital with an expanding consumer base that is desperately demanding better solutions for the afternoon crash, and you have a very powerful setup.
What's the overall sentiment from analysts on that setup?
Analysts currently give this a bullish score of 8 out of 10.
8 out of 10. Okay.
But you must understand the target horizon if you're building a position. This is not a quick flip. This is a multi-year hold designed to capture the value creation leading into the major FDA milestones expected between 2026 and 2027.
Okay, so let's bring all these threads together into a clean, actionable thesis for your wealth building strategy. Here is the elevator pitch.
Let's hear it.
We are looking at a company that possesses a proprietary technological moat in the precision-timed release space. They're targeting a $10 billion ADHD market that is desperate for a solution to the afternoon crash.
Yep.
Analysts are projecting 56% revenue hypergrowth once commercialized. They've secured fresh, specialized institutional capital that neutralizes the immediate pre-revenue bankruptcy risks. And Wall Street targets are pointing to an upside of nearly 600% as the company aggressively narrows its losses toward break-even by 2027. Did I miss anything?
That's the core of it. It represents a calculated asymmetry in the market.
Yeah.
The risks of FDA delays are very real, but the current share price reflects maximum pessimism from retail investors. Meanwhile, the institutional money is quietly positioning for maximum optimism based on the underlying science.
It's a fascinating dynamic.
It is. And I want to leave you with one final concept to mull over as you build your strategy today.
Okay.
Everything we've discussed today has focused on one single ADHD drug. But if this precision timed release technology successfully revolutionizes how stimulants are delivered to the brain by eliminating the crash, what other central nervous system disorders could this proprietary delivery system be applied to next?
Oh, wow. I didn't even think about that.
Right. The true long-term upside here might not just be a single successful ADHD drug. It could be the massive licensing optionality of the technology itself across an entire spectrum of neurological treatments.
That is a massive thought to end on. Thank you for joining us for your daily stock analysis. We'll see you next time.